Good afternoon, everyone. Thank you so much for joining us today. I am here with a wonderful panel of experts on a topic that is definitely relevant to our business community today. So thank you all for joining us. I am Kay Hilling with the Chamber, and I am always happy to be here to connect you with businesses, information, and each other. And with that, I will pass it over to Lisa, who is fronting our panel today. Go ahead, Lisa.
Thank you, Kate. So welcome everybody to Secrets to Maximize Value Prior to a Business Transition. My name is Lisa LaVecchia. I'm a wealth management advisor at Merrill Lynch, and our discussion today is about business succession. Do you know that 60% of boomer business owners plan to transfer $10 trillion over the next 10 years? However, more than half don't have a formal succession plan in place. Typically, we see this transfer happen through something called a triggering event. That is an unexpected external event that impacts a business, like a death or a divorce or a partner leaving or getting sick, or even an event like COVID. Many entrepreneurs are so focused on their business, the day-to-day operation, that they don't take the time to review the options regarding a transition. And what they often fail to realize is that a thoughtful and thorough succession planning process can actually strengthen their current business operations, protect their wealth, and the vision of the life that they're going to have after business in their next chapter. Successfully transitioning a business is directly correlated to how early you begin planning. And some of the benefits of early planning are the following. It gives you the opportunity to maybe increase the value of your business, establish financial security in retirement, provide for family members, or minimize taxes efficiently and transfer wealth. And using a team approach and consulting with a group of professionals that focus on how to protect your wealth and extend your legacy is key to a successful transition. So I would like to introduce to you our panel of professionals that can help to facilitate this process. First, I have Sean Hutchinson and Cindy Reed Shelton, who are business value acceleration consultants. They together are global partners for a firm called Ready for Next Advisory Group, and they help business owners and entrepreneurs achieve ideal business outcomes. And then I would also like to introduce to you John McManus, who is the founding partner of McManus and Associates, an estate planning law firm, and his partner, Ben Cartho, who is head of their wealth transfer and private client group. So Sean, let's begin with you. Can you tell us a little bit about the value acceleration process and how a business owner should begin to think about what the most important things are that they should be thinking about when they start thinking about transitioning a business?
Absolutely. Thank you, Lisa. It's a pleasure to be here. So let's real quickly break down the value acceleration process into three parts. So part one would be discovery. What's going on in the business? What's going on in the owner's life? What are the kinds of goals that they want to achieve in whatever period of time it's important to them? Then moving in and then creating a plan for value acceleration. Part two, actually implementing that plan. And that plan can take 3 to 5 years to implement, depending on where you are in the process. So you might be just starting the process of planning for some type of ownership transition, or you might be kind of late stage. And as Lisa mentioned, there could be some triggering events that kind of accelerate that process for you, like an unanticipated illness or something like that. Then the third part is making a decision about, are you going to keep the business or are you going to sell the business? And that's an important decision because we've had owners go through value acceleration with the intent of transitioning out of it. And then value acceleration turns out to be so fun and the business improves so much that they decide to stay in it for a while longer. So it's about the agility of the process, making decisions, being ready at any given time for what may happen in the future. Let's talk a little bit about that first piece, which is goal identification and clarification. So here's some of the issues and questions that are going to come up. For instance, what's your end in mind? And of course, we all say, not entirely facetiously, your end in mind should start planning for an exit when you start the business. Well, that doesn't happen very often, but as early as possible, you should be thinking about what do you want to do with your shareholder position in the business. And Sydney's going to talk about some options in just a few minutes. Why does a transition matter to you? Why is it that you want to transition, or if it's not an involuntary trigger, this may be a life decision. There are lots of different reasons, but think about why it matters. What's not on the table for you? What kinds of transitions would not be, you wouldn't entertain, or other family issues that you want to manage? And then can you put a stake in the ground in terms of timing, in terms of the value at which you want to transition? Those are all important goal identification and clarification steps. Now let's talk about getting organized. So some of the things that are going to come up that you have to prepare for, and you can do it by kind of creating a virtual file cabinet, if you will, of documents and other pieces of analysis, other pieces of information that are going to be important to this process. And here are some examples. First of all, one of the places where we see a lot of owners struggle is with financial statements, good, solid financial statements. So can you explain the trends? Can you explain some of the granular details of what's going on financially in the business? Those trends are really super important. In other words, what's happening now versus what was happening 2 years ago or 1 year ago, understanding the movement of money. Margin management on the financial statements. Are the margins being squeezed, right, to a lower level, especially the gross profit that's watched like a hawk, not just the bottom line, not just the growth rate. So understanding how your income statement is organized. Also understanding how it fits in with the other two parts of your financial statement, your balance sheet, which a buyer can tell a lot from studying balance sheets over time. And then also your cash flow statement. All of those are going to be super important. What I would say is a good practice here is to have an outside accountant look at your financial statements annually, quarterly, whatever that looks like, and do a review, right? Which is a level below an audit, but it's still really important to have that outside review of your financial statements prior to the time that you're moving towards a transaction. And I would prefer to see 2 or 3 years. And then doing some financial benchmarking. What's going on in your industry? Where are your peer companies? How do you stand up against them? That's going to be important when you get into valuation. Other things, corporate documentation, formation, buy-sell agreements, if you're in some type of partnership or a shareholders agreement, governance, minutes from your board meetings, if you have a board, customer information and contracts, systems and process documentation. How do you train? What are your standard operating procedures? So that's where that virtual file cabinet is starting to come together. You dump a lot of stuff in there and you start to organize it. When people start asking questions about it in the transition process, you are well prepared to answer them, and you have to be able to answer them quickly. Now, knowing your number, let's talk about valuation for a minute. So there's a lot of power in understanding the value of your business, what generates that value, in other words, the value drivers, and also what kills that value, what holds it back, so tailwinds and headwinds. We often do a thought experiment with our clients, which goes like this. Hey, if somebody showed up your door today and said, I've got a check burning a hole in my pocket and it's worth a lot, are you ready to sell? And what do you think about the value? I'll close this thing in 30 days, which is crazy, but let's say that that's the thought experiment. Are you ready to have that conversation? Would you entertain someone coming to your door, knocking on it? If you do not know the value of your business, if you haven't thought about how it ties into your goals, before the chances are good, you're not ready to have that conversation. And in fact, it would probably be a waste of time. So get it valued annually. It doesn't have to be a certified valuation. It could be a calculation of value. There are lots of different ways to do this. So it depends on what you're going to use it for. If it's estate planning, it may be a certified valuation. There are 3 approaches to consider: asset, market, which is comps, and also income. Income will by far, in most private businesses, drive the valuation of the business. So concentrating on margins and profit, super important. The better you can do that, the higher the valuation. What's important in your industry? Is it growth? Is it profit? Is it something else? Buyers are going to look at you and benchmark you against your peers. And then there are 3 broad ways to increase value: increase the earnings, reduce the risk in your business, and also communicate best-in-class features of your business to the marketplace. Position yourself. The biggest effect on value will be risk, not increasing earnings. So it's important to understand all of those things and how they fit together. Lisa?
Thank you, Sean. So you've highlighted the two most important things, getting organized and making sure that you have a good number, a good valuation of what that business is, and then to take the time to do it, and even to do it on an annual basis. So Cindy, can you outline for us some options for succession? What are the options that people have if they're thinking about transitioning their business?
Okay, thank you, Lisa, and welcome everyone. There are internal transfers and external transfers. So when we talk about transition options, there's really a marketplace that is inside your business and outside your business. So we talk about these internal and external options, and it's interesting to note that a lot of business owners are very underinformed, I guess you could, like, they're aware of certain transfer options and really not the larger set. So you could be turning in saying, I think that I'm going to be looking at an internal transfer, intergenerational. So that's your family, right? And then you've got management buyouts that are also an internal transfer. You've got employees. So it might be employee ownership. Esop is a word that most might be familiar with if they've explored that. There are also external, which are your third party kind of strategic buyouts. That's your competitor or somebody out in the marketplace that wants to absorb you, acquire you, integrate you into their business. Recapitalizations, private equity. There's unfortunately orderly liquidation is also an option, which simply means that you're going to shutter your business and close it up. And we don't have enough time to go into each of these, but they're not static. In what I mean by that is that you don't have to choose one or. So you're not confined to saying, I have a family member that's interested, son, daughter, you know, whoever that might be, and that's the direction everybody expects me to go. Or I have a management, like a buy-sell agreement. Maybe there's multiple shareholders. The complexities are numerous if you have more than one shareholder, of course. And the goals of each of those shareholders have to be weighed carefully, because people are going to have different timing for retirement or for transition that is in their consideration. You're going to have different wealth needs. Like, it's so incredibly important when we do planning for any of our clients, and we also teach the different professionals in this space as well. We emphasize the need for planning for what we call three legs of the stool. And the three legs of the stool that we're referring to are making sure that your personal financial affairs are well in order and well understood. That being, what are your liquidity needs? What are your wealth transfer goals? If you've got legacy goals that you want to take into consideration when looking at your transfer options. I can't emphasize enough the importance to look to teams like Lisa's. So get individuals that are in the planning space, the wealth planning space, to help you to understand what your true needs are for your lifestyle expenditures for the rest of your life. Understanding that number informs your transition options choice. So internal here at RFN, so at Ready for Next, we take our clients through what we call a feasibility analysis for all of the different variations of transfers that could occur. We actually look at whether there's a fit there and whether or not there's a feasibility to an option that has to be considered. And we have to look at whether or not there's buy-in from the various shareholders to each of the options. So we weigh their goals against the options, and then we assess what the true fit is for each of those options in accordance with each individual shareholder's needs and goals. So at the end of that, though, you get a very clear picture of the direction that you need to go. And I'm mixing up a little bit the transition options analysis and the structure. And I know you wanted me to talk about structures of companies and how they're important. First, understanding your needs, marrying up those needs with, okay, what are my options? Fully understanding the pros and cons of each of those transition options is imperative to then understand what structure do I need? What type of structure do I currently have? Is it something simplistic? Do I have multiple entities that are involved in my organization? Are there trusts? Is it a C Corp, an S Corp, an LLC? Like all of those things need to be assessed as to whether they can actually support the transition option that is the highest priority or the highest goal for the shareholders. So we take a look at that and make sure that all owners are sufficiently informed. So they go in eyes wide open to understand the pros and cons and consequences and implications of each of the different options. And we help them to match up the business, the transition of the business with their individual shareholder goals, family goals, legacy goals, and put all of that on the table so that they have a well-informed path that they can start to walk. And you're right, Lisa, the sooner that you start to contemplate these things, the sooner that you start to get your documentation in order, it's just good business practice. You may be what you consider light years away from an actual transaction, but we can tell you it happens all the time. Somebody knocks on your door and says, I'm really in the market for an acquisition and you look like a perfect fit. And you don't have time to get your ducks in a row to be able to successfully transition the way that you would like to for the optimal value that you're entitled to, because it's too late if you're going to consider that potential suitor. You have to have these things done in advance of a possible offer or letter of intent. So being transition ready, and we say this every day, all the time, being transition ready actually makes your business more valuable for a lot of reasons. Lisa, I'm going to throw it back to you.
Thank you, Cindy. That was terrific. So just to reiterate, options for succession, it could be inside the business or outside the business. And then once you understand what you're trying to do and which way you want to go, looking at the structure of the sale, how it's going to be put together. So all of this is extremely important. And it's also very important, again, to think about this ahead of time, to be ready for a transition, to anticipate it before it actually happens. So another aspect of this that it really requires you being ahead of the curve is whether or not you're going to structure certain type of tax efficient and wealth transfer strategies prior to getting or having a letter of intent. And I'm going to bring on John McManus to talk a little bit of the different type of tax strategies that are available for effective wealth transfer.
Thanks very much, Lisa. Are we off? Do we have me off of mute?
Yeah, you're
okay,
good.
Excellent. Both Sean and Cindy, I think, bring up very, very important points, which I think launched from your setup on this, Lisa, which is the notion of preparing. And I've told you this story before. My grandfather emigrated here from Europe and in 1921 started his own business. This year, that business crosses its 100th anniversary, which is the moving and rigging of artwork and pianos and furniture at the ultra high end, including statues throughout New York City. They have the only permit to use a helicopter to bring these pieces of artwork into the sides of buildings and through the roof and into the windows. He never spent a ton of time on the succession piece, and it's just so critical for us all to think about that. There are two pieces, though. One is preparing for the sale, and as you heard Cindy and Sean suggest, that you will get a better number if you're thinking about this ahead of time, even when it's dealing with the IRS on audits. If you can respond quickly to them, they take you far more seriously, and you have much greater credibility. So preparedness is essential. The other piece to this is not just on a sale, but what happens if you pass away. And where does that go? So when my grandfather passed away, he had no one to stress test his business and his estate plan. His son took over, but his plan, which would be my uncle, to have a portion of it be with my uncle, a portion of ownership be paid back to my grandmother, and allocations to the siblings was never really thought through family meetings, through discussions of valuations, through who would oversee this in the form of a trustee and the executor. And what happened was, as we say in organized crime, all the family went to the mattresses, and it became sadly a war that the family never recovered. And the only winners, Lisa and Sean and Cindy, were the lawyers. And I can remember being a young child and saying to my father, "How could this be?" And he said, "If you ever choose to be a lawyer, don't be this, because I believe that the lawyers now are not prepared when they're before the judge, and the judge admonishes them, and all the money is going out, evaporating sadly to people who are litigating this and just collecting fees." The family never recovered. The earth was scorched. My uncle accelerated the business and did wonderfully with it, but there was never anybody in the family to take over that business. And as a result, because of the hard feelings, and he wound up having to sell it. And that name still runs around New York City with my grandfather's name and all of his designs and ideas, with a family that knows nothing about us and is benefiting from it. So there are two pieces to this. The one is, how do we have the formal transfer during lifetime to the shareholders, the employees, to an outside purchaser, and how do we prepare? But what happens if we pass away and have decided to keep the business in our name? And we have had to take over a law firm where, sadly, in the past 24 months, an attorney ran this firm, and he was the sole principal. And an equally similar set of facts. And the sadness, Lisa, is that everyone on this call that's listening in is an entrepreneur and has given their blood, their sweat, and their tears to build this business. And if they are part of the chamber, there's no doubt that they not only are proud of what they've done, but they take very seriously the success of their business going forward. And the result here is not just how do we transfer this in the most tax efficient way, and Ben will speak about this, but also what happens if we pass away, and how do we accelerate effectively what becomes a sale at the time of our passing. And that's why the work that you're doing today is brilliant from an estate planning standpoint, but also from a wealth transfer standpoint that takes place during lifetime. Where are the efficiencies of what we can do? And there is no time better than the present. The second thing that we'll talk a little bit about, and Ben can bring up, is the new tax laws are limiting the efficient tax-free or minimized tax transfer from one generation to the next. And we need to continue to address that. This administration is profoundly focused on minimizing the transfer of wealth without taxation, and what should be done. So, with that, I'm going to pass that off to Ben Carthew, who runs our wealth transfer practice area at the firm. And as we cross 30 years, there is no single person that has done more work for us in the firm in the most complex way. So thank you, Ben.
Appreciate that, John, and thank you everybody for joining this afternoon. As John suggested, I'll first talk a little bit about the conversations that we have with our clients in advance of an exit, and where that provides some tax benefit, either from a future estate tax standpoint or from the perspective of the potential of minimizing income tax. And we're going to continue to hammer this point with everybody on the panel. A lot of these efforts do require planning in advance to get it done and to most effectively deploy these techniques. At its heart, the reason why the sale of a business provides us with a great opportunity to treat this as a wealth transfer opportunity is because we can get an asset value that is relatively low compared to what its future value is going to be post-sale. And that rule of thumb is one that guides us a lot, because if we're making a gift and all of the growth in value takes place after the gift has been made, that's where your children and your other loved ones' future estate tax savings lie. All of the appreciation taking place off the balance sheet. And what is coupled with that is when we're dealing with private companies and illiquid assets like interest in an LLC or a partnership or shares in an S Corp or C Corp, there is an opportunity for valuation discounting. And what that basically means is, I'll give you an example. We have a $15 million business, and it's segregated between Class A voting shares owning 1% and Class B non-voting shares that are 99% of the equity interest. Those non-voting shares, which don't participate in the management of the business, can't make decisions, cannot be liquidated, cannot be transferred very easily, and cannot force a dissolution, they are not worth $14 million in value because of all these constraints. So when we look at transferring those shares, there is an opportunity to reduce them for gifting purposes. And why is that important? Because there's a limit in terms of how much you gift during your lifetime. Right now, that's $11.7 million. So in that type of arrangement that I just described, when you have a business that is 99% non-voting, just as an example, knowing that there are all these limitations in place, you're not making a $15 million gift to get those non-voting shares out of the estate. Instead, you're making something more like an $11 million gift. And why does that work for us? Now you can transfer effectively all of the business without being subject to a gift tax. And then when the business liquidates, maybe it's for 30 million, maybe it's for 45 million. And if we have time a little later, we'll go through a particular case study of a client of ours who went through this recently. All of that growth, the difference between the $11 million discounted gift and the $30 million or $45 million asset that it ended up turning out to be post-sale, that is all outside of the estate, off the balance sheet, and not subject to estate tax. And so that is where our clients see a lot of power in considering the transfer of a non-controlling interest in a business before that sale takes place. I want to talk about another technique, which many of you may be familiar with, and it is something that is relied upon when you've used up most or all of your gift exemption and you can't give away any more without incurring a gift tax, or you have some expectation to directly participate in the proceeds after the transaction has taken place. And this is something called an installment sale with your grantor trust. That's the trust that would be the recipient of the gifts that you're making during your lifetime. The reason why it's an effective tool is you're able to sell your non-controlling illiquid interest in the business at a discount, okay, to the trust, and then the trust owes you a note back based on that discounted value. And in the example I just gave, the $15 million business where the 99% voting is worth $11 million. In this instance, let's say you're taking an $11 million debt back, okay? So now what has happened is when the business ultimately sells for $45 million, the trust gets the 45 million, it pays you back the 11, so you're participating in some of the in some of the benefit of the proceeds. But that difference, the difference between 11 and 45, that $34 million, that is now in a trust out of the estate, protected, and you haven't used any portion of your lifetime gift exemption to remove that growth out of the estate for the next generation. So installment sales, whether it's a situation where you've used all of your gift exemption or you wish to at least participate directly in the proceeds, are really, again, effective technique for transferring wealth multi-generationally. On the income tax side of things, just to touch base on a couple of concepts there. More and more, and this is particularly true ever since the state and local tax deduction was capped at $10,000, a lot of our clients have been interested in finding where they can save on state income taxes, knowing that they're not getting the credit for the deduction on the federal level. And this plays nicely into a trust concept where the trust is located out of the state of New Jersey. Okay, it could be in a state like Delaware or Nevada or South Dakota. These are very common jurisdictions that have no income tax imposed on a trust. And if you've gifted or otherwise transferred that interest in the business to such a trust and the business is ultimately sold, because that trust is a resident outside of the state of New Jersey and does not have any New Jersey trustees or New Jersey-based assets or source income, the sale of the interest can take place with zero New Jersey income tax. Okay, so that what we call a non-grantor trust has become a very popular tool for being more efficient and having immediate income tax savings when the liquidity event happens and the business is acquired. The last income tax planning tool involving a non-grantor type trust is one where you have a C Corp that is considered to be a qualified small business. And this pertains to what's called a qualified small business stock exclusion. And what that means is you have the ability, just yourself as an individual, to exclude $10 million worth of capital gains from the sale of those C Corp shares when that transaction happens. Now imagine if you have a $50 or $100 million business that is going to be selling, then that $10 million can only go so far. You still have a really significant amount of gains. But the way that you've been able to amplify that through a non-grantor trust is you can create multiple trusts for the benefit of different individuals, each of which has its own $10 million gain exclusion. Okay, so that means if you have, in this example, your own individual $10 million exclusion and you create 4 trusts, one for each of your children, now you have the ability to exclude $50 million of gain and essentially realize zero federal income tax on the sale. So what we call stacking these QSBS exclusions can be, is really the most immediately consequential thing that, you know, we can do on the income tax saving side. And it's a matter of discussing with your accountant and others, you know, who may be advising you about whether your business is considered qualified for this type of exclusion. Okay, and I'll just close before we head to the next topic on the notion of the changing tax laws that John alluded to. There is the potential that some laws are adopted that could impact any or all of what we're talking about. We know by the time we get to the end of 2025, if not sooner, the gift exemption can go from $11.7 million to $5.85 million. It will effectively be cut in half. So there's less opportunity to transfer wealth during your lifetime as efficiently. We know that valuation discounts have long been on the radar of the Treasury, and that even if Congress does not take action to eliminate the ability to shrink the value of businesses for gifting purposes, it's something that the Treasury Department can perhaps modify by reinterpreting their existing rules and eliminate it in that way. That is something that was proposed during the Obama administration. Separately, there, as a part of the current version of the Build Back Better Act, there may be an institution of a surcharge on non-grantor trusts. And if a non-grantor trust has income above $500,000, it could be subject to an additional 8% federal tax. So it takes away both the benefits we're getting on minimizing state income tax and also limits the benefits of taking advantage of the QSBS exclusion, which is also threatened to be cut in half. So there are a number of moving parts that could come about or may not come about, but that we have to remain constantly mindful of that will impact the potential plans going forward.
Thank you, Ben. A couple of things at the end, I think, but throughout the course of your discussion are really central and salient to the topic. So some of it, Ben, is what happens if we sell the business, and how can we structure a vehicle to avoid the gains tax at the time of the sale. And you brought up setting up the trust, for example, in Delaware, Nevada, South Dakota. We're working more these days with New Hampshire. We worked in Alaska before that. That requires that the business be sold. And so the issue that we are confronted with in the audience is, if you don't sell the business and the law changes, would you benefit from setting up this trust? And the answer is we don't know, because we don't know what part of the law will come through. Senator Manchin just commented today again that inflation is impacting his decision making. And we're watching what's going on in committee and on the floor by the hour, listening to podcasts, reading the news, so that we're able to comment as folks reach us. But the intelligence of considering to set up the trust and taking even some fraction of the value of the company and moving it into trust to minimize the tax, we believe is a small investment for the outsized return of avoiding the state income tax. And if QSBS continues to be preserved and sacred as a credit, up to $10 million per trust. As Ben said, you can stack them and break the company up depending on the structure of the company. The other piece, Ben, that I thought deserves to be reviewed again is the gift exemption. So the gift exemption is almost $12 million. What does that mean? That means that's how much you can move off your balance sheet while you're alive and not pay any gift tax. The IRS wants you to die with as much in your estate as possible. And they want the assets to touch every generational level so that they can pay their toll as if they were on the old toll booths on the turnpike or on the parkway as you stop and you pay the toll. Our view has always been to do generational work so that we go through an easy pass, but we get a discount on that. And the answer is at 11.7 million, you can move much out of your name, but you may say, I don't want to move 11.7 million, or others may say, I've got so much more. And so then the thought process here is you can, if married, your partner, your spouse can take a portion of the ownership of the business, and you can move two chunks of the company interest into trust. At this time, while the death exemption and the gift exemption, either during your lifetime move it out or take advantage when you pass away, put you at nearly $23 million, right? So with that exemption is scheduled to decline. It is scheduled. It has been part of this list that the Build Back Better bills are focusing on. But we know that regardless, Trump, who was the most anti-tax and had both houses and the White House to support him, was only able to get this exemption to 11.7 million, adjusted for inflation. But then it would retreat at the end of 2025. We know this is coming. And so the thought is, do you get more of your assets out of your name now? Do you take some fraction? And think about the discussions here today. We're coming to know the value of your business, seeing where your succession could be in the business, where you would be, being prepared in the event that you want to sell or an offer comes your way, are central. But equally, is it a time to take a slice of the business and move that into trust and let that growth take place off your balance sheet while you have this opportunity? And the answer historically is, if I can maintain control of the overall business, if I know that my spouse can be a beneficiary of that trust, if I know that all the growth in this trust will take place off my balance sheet, and then when there's a sale, the proceeds for that portion of the company will go into that trust, and all that growth will be separate and outside of my estate, is why people find this so compelling. Our best clients are those who have had one sale of a business and missed the opportunity and said, I will never let that happen again. And it goes back to what you're hearing today with your with this panel, which is preparation for the sale starts at the starting point, right? From my grandfather, it should have been 100 years ago, right? But for him and so many of us as a business owner, we are impassioned to grow and to reinvent and to be to pivot as challenges like COVID came, to be thankful for our growth, to honor our top staff with us at our companies, and to look to the future, but not necessarily to say this transfer is going to have a significant tax, or this transfer is not on my death is going to be one that's going to be hit with a significant estate tax. Or are they prepared? Are we preparing our heirs for the inheritance of this business? Are they ready to take over management? And that planning is what we speak about today. Often we speak about flattening out the balloon and then being able to slide that balloon under the door frame, being the tax threshold, and poof, letting it blow up on the other side. That is exquisite estate planning, because you're shrinking the value and then you're transferring it and letting the value explode on the other side into trust. All of those strategies are now not only under review, they're under attack. President Obama was very assertive in his second term to say that the ultra affluent, in his mind, and today many are simply business owners who have given their blood for a generation or two, that they need to pay their fair share. Today is not a comment on whether that is right or wrong or injustice in society. What we're saying is that today these strategies are available. And those in the administration of the Obama, during the Obama period, are now in the Biden administration. And their president may be more flexible. Some may argue even more malleable. But those that are advising him are smarter and more sophisticated, more galvanized in their commitment. And frankly, we know this because they're our clients' children. So we need to know that there is some urgency about at least considering planning from a standpoint where it is some sliver of ownership can be moved over. And what better time to think about the efficiencies of your business and preparing for a potential sale that may never come. That may never come. You heard early on in this discussion that wouldn't it be great to do all this work and say, I'm happy. I may stay for years or for a generation. I've honored all those around me because of that work with me, and they're getting paid more and they have job security better than if this company was sold. But in the meantime, we know that at some point you all will leave this earth, as will we. And what can we do to have the orderly transfer in the most tax efficient way to continue to honor your mission of your company? So with that, Ben, if you could take part 2.
Thank you. So Ben, can you give us a little bit, a brief discussion about the type of communication plan that is necessary among the professionals that are on a team helping a client facilitate the transfer of a business? We know it's not just one person, it takes a village. They're usually, as we have here, a value acceleration, a estate planning attorney, accountants, corporate attorneys. There's a lot of people that are involved. Can you give us a brief, a kind of description of that? And then we'll have a couple of minutes. I'm going to reach back to Sean and Cindy about some ideas regarding some clients they've had that have successfully transferred as well. Thanks, Ben.
Yes, we'll be a little briefer on this one. There's a lot of nuance in the other stuff, but this is more direct. It does take a village when a business is being sold, because there are any number of different professionals involved in that transaction, each with their own area of expertise, each with certainly we would expect the same overarching goal of maximizing the yield from a liquidity event, but sometimes with conflicting interests, and certainly with a need to all be on the same page in terms of what one another is doing. It starts with the business's accountants who can share the history of how the business has been classified from an income tax perspective, whether a partnership, S Corp, or C Corp, whether there are things that should be done in advance when it comes to that tax classification to maximize savings at the time of the sale, and certainly to inform the other professionals as to what the consequences would be without any further planning. There are corporate counsel who, if from the standpoint of the estate planning perspective and the wealth transfer planning perspective, if gifts or other transfers are going to be made, corporate counsel is necessary to make sure that all of the formalities of that transaction are being observed. Are the right people being notified that a gift is being made? Is there any consent required? Does there have to be a tax selection made in order to preserve status as an S Corp? Those types of things all go into just the pre-transfer of planning and are very critical. Of course, the counsel who is helping out on the M&A side will have a viewpoint in terms of the structure of the deal and what sort of tax consequence that may result as to whether it's a stock or an asset sale or other type of arrangement. The wealth managers must be involved for the post-liquidity transaction, because of course there has to be a plan in place for how the wealth is going to be leveraged going forward. What vehicle is it landing in, family trust or otherwise? Who are the participants in that? And what are the long-term goals for the family who is ultimately benefiting from this? So again, it truly takes a complete team-based approach to make sure that all of these different issues, and there are even more beyond that, are being navigated appropriately to get the optimal result. Thanks, Lisa.
Thank you, Ben. Thanks for explaining that so clearly. We really appreciate it. So John outlined this client situation, his own personal family, where it really emphasizes that, there wasn't the planning that was necessary, and the family at the end didn't get the result that they necessarily needed. And he eloquently illustrated what has to be done ahead of time and why that's so important. And then followed up with the specifics around that. Sean, can you tell us a scenario in a couple of minutes? We have about 10 minutes left. So just a scenario that a client came to you and we went through this process and you've had success. You were able to put them in a position where they actually maximized the value of the business and got more than what they thought they were going to get. Do you have a story you can tell us?
Yeah, I have a lot of stories I could tell. But one that I think is really instructive because it goes to the flexibility perhaps and the need for flexibility in putting together a transition plan, which is really about design. It's about taking puzzle pieces, some of which you may not even know are there when you start the discovery process, really listening to the client about what they want to accomplish and designing to that. In a lot of cases, I've found that professionals, we are experts. We like to talk about the technical side of our business, but sometimes we struggle to really listen to what the client is telling us. So we had a case where I really am proud of the transition design, actually, and that's why I'm going to relate it. But it was complex. This was a business that was running about 120 million in revenue. It was a third generation family business that had gone through a couple of different iterations in terms of the kind of business it was, but it had ended up in the third generation being a heavy equipment dealer distributor with a lot of heavy assets, right? A big balance sheet on the fixed asset side. And they had to buy a lot of expensive stuff up front in order to make it, in order to deal it or distribute it or use it in their own businesses. So they had a lot of debt on the balance sheet. There were 4 brothers that ranged in age from on the young side, 62 up to 78. They'd all worked in the business for many years. But the 78-year-old and the next sort of 2 brothers who were a little older, younger than the 78, but older than the 62 by a good bit, they wanted to get out of the business. But because the business had a lot of debt and because they had a really restrictive formula in their buy-sell agreement, it really didn't make a whole lot of sense for the older brothers to exit at the same time because the proceeds from the sale would have been really limited to them. They also had some expiring life insurance. So if one of the brothers were to die, the older one owned 30% of the company, then the company he really wouldn't get a whole lot out of the sale, but their life insurance, even so, was inadequate to cover that risk to the company. Normally the life insurance would be paid, the proceeds would be paid to the company would use that to buy the shares back from the estate. So we had a real challenge there, how to get the brothers out. And they had been thinking about it as we all have to go at one time. And we said, well, you don't really have to do that. You can do that in a staged way over a longer period of time. The first person could get out at one value, the second person at another, the third person at another. And as the company grows, the value may grow for those later exiters, but the 62-year-old who was CEO of the business wanted to stay in. He didn't want to sell any equity at all. But he also had family members in the business that he wanted, I like John's word, honor what they had contributed, how they had contributed to that value. They weren't equity owners in the business, but he wanted them to be. There were actually 2 sons from 2 of the brothers. But there was a challenge there too. They both had different roles in the business. One was executive, one was more operations. In the field, they really had 2 different salary points. There became questions of fair versus equal. All that's going to kind of come up. They also had key employees that they wanted to honor who were not part of the equity. Now, luckily, we had a lot to work with because they were a C Corp. So we could create different classes of equity. We could restructure the company to make room for everybody. And because of what Ben was talking about, you could get pretty creative about what the value of those shares were in the beginning. So if there was some kind of gifting strategy, not just intergenerational, but grants to the key employees, they might not be taking on a big tax burden at the time of that grant. It could be a different kind of arrangement. So what we ended up doing was setting up an employee stock ownership program, the ESOP. A good portion of the business was going into the ESOP. Some was going to be created in a second class of shares for the family. The family was able to maintain control of the business, which is one of the nice things sometimes about an ESOP. There's some nuances there that are really nice for the founding family. And we were able to create a class of equity for those key employees and insure them properly against the growth in value. Now, best laid plans, right? Here's the sad part of the story. So all that gets done. We have the plan in place. The ESOP is established. The transactions are starting to happen there. They're very tax efficient for any owner, probably as transactions go, ESOPs are really tax efficient, more so than others without estate planning. And then, so we've got this plan in place, and what happens? The 62-year-old, this is about 2 years ago, the 62-year-old gets sick with COVID and passes away. He is the least insured person of the brothers. Now we've got a real problem, right? So, and everybody kind of gasped there, but these things happen. Bad things happen to good people. So now we're going back in and we're saying, all right, how has this changed the design? There were some financial issues that we had to overcome, right? There are obligations under the buy-sell to buy out the estate, but he owned the least part of the business. It was less important there. When we analyzed, it was less expensive there. When we analyzed the plan, it actually could remain in place. Even though he had lost the younger brother, we could make the plan still work for the brothers, for the key employees, and for the intergenerational family members. That family member tranche of equity as a result of that death became extremely important, because now there was a whole conversation around legacy. What was that multi-generational strategy going to look like as it moved into the fourth generation? And frankly, John, I think that went back to some of the things that you relay as we want this business to stay in the family, but legacy. So legacy was important to them, but they defined family more broadly. Employees, key employees, family members. How would we structure that? How would we time that so that as many people get what they need to get out of this as possible? That's an extremely difficult transition plan, but it shows you how you can mix and match these things and be really creative. So it's not, as Cindy said, it's not either or. It's not pick a third-party transaction or pick an inside. There's so much that you could do if you understand your options and working in an interdisciplinary team, like the people here, adding the legal expertise, adding estates, wills, trust, adding accounting, adding value growth. This company was worth, 70, 80 million, but we could chart a path through this transition plan to 120 or 130 or 140. But that value acceleration had to be a part of the story so that the younger employees and intergenerational family members were actually going to get wealth out of it in the future, right? It's not just one transaction. You have to think across the generations and plan a long way out into the future. If someone's selling, someone's coming in. If it's family or employees, you have to make room. They want to grow the value of the business. They just bought into it in one way or another. They want it to be a better valued company in the future. So everybody's on the same page and aligned around what are we going to do in the future. There are no conflicts of interest there, and everybody's kind of rowing in the same direction. That's the power of transition planning, I think, is boy, it focuses people and really brings home both the complexity but the exciting part of planning.
Thank you, Sean. That was terrific. And thank you for tying that all together. So I hope the message we conveyed to you today, the importance of planning early, I think that's the most important thing. And to realize that we need a team of professionals. And you can see by today, the expertise from Sean and Cindy and John and Ben is, immeasurable. So we would love to be able to continue this conversation. There's a lot of information and it's very complex, and we can look at each area and spend an hour on each, at minimum. So we are happy to provide more information. We will also be providing more webinars in the future. And we want to thank you all for spending time with us today. And I want to thank all our participants. And we hope that you found value in our discussion today.
Absolutely. So thank you so much, Lisa. That was jam-packed full of information. So thank you. I was following along, and I'm not a business owner. So I really appreciate this valuable information for our businesses in our chamber and outside as well. So I really hope that people took away some great nuggets from this. So thank you to the wonderful panel. Thank you to Lisa. And we hope to see you at the next webinar or in-person event. So take care, everyone.